good morning, good afternoon, or good night, depending on what part of the world you're visiting us. Hi, I'm Daniel Marcos. I'm CEO of the Growth Institute and the author of Impact X. And today I'm super excited. I'm here with a big mentor of mine, John Warrillow. He has written several books. I'll talk a little bit more about that. And we're going to talk about how to create a successful exit plan, how to really prepare a company. And we're going to talk a lot about Value Builder System, this organization that John has built. But most importantly, this book that changed my life when I read it, called Build to Sell. As entrepreneurs, we build companies and we're all focused on growing the company, but we never understand and really dimension the impact on selling the company right and building it to be sold. And that's precisely what we're going to talk about with John. Let me give a little bit of information on John. John is the founder of the Value Builder System, a simple software for building the value of your company, used by thousands of businesses worldwide. I am a Value Builder certified consultant that I help all my clients using John's methodology. And he also wrote the book Build to Sell that I already explained, creating a business that can thrive without you. And then also the automatic customer, that after he wrote the book, I changed 100% the business of my business model. When I read it, I felt dumb that I did the other way. And I went into memberships and recurring revenue. So John, thank you very much. You've been very impactful in my life. I am very grateful. I've been following you for many years, and it's a pleasure to have you here on the podcast. How are you?
Thanks, Daniel. Great to be with you.
So John, let's go back to the idea. Why do you start helping companies sell, and why you wrote Build to Sell? What pain did you saw in the market?
Yeah, well, it's not what I saw, it's what I experienced, because I had built a couple of service companies. My last one was a research business that had gotten to about 5 or 6 million in revenue. And we were one of those profitable service companies where, there weren't a lot of hard costs associated with the business. And so we would put 20 to 30% profit before tax on the bottom line. We were, $5 or $6 million company. So it was a good business. And I decided I wanted to sell it. And I went to see a guy named Perry Miele in Toronto. And I said, Perry, what do you think it's worth? And I was rubbing my hands together, waiting for the answer. And he said, well, before I tell you, let me ask you a couple of questions. I was like, yeah, go shoot. So all right. So who does the research? We were a market research company. And I said, well, I'm involved in some of the research. He's like, all right, well, who does the selling? And I'm like, my name's on the door. Of course, I've got to be at the key client meetings. And he's like, so let me get this straight. You're a research company. You do the research and you do the selling. And I could sort of tell where he was going with the line of questioning, but I realized at that moment that I was not building an asset. And Perry confirmed it. He said, look, I can't sell your company. There's nothing to sell. And, I had walked into his office thinking I had a business that was, worth a decent multiple of profits, which were, in the 7 figures. And I left thinking I had built nothing. In fact, I, had built really just the job. And so that sparked for me, this goes back 20 years ago now, Daniel, a bit of a journey for trying to understand what drives the value of your company. Ultimately, I was able to kind of convert that business into a subscription model. We hired a bunch of salespeople. We kind of morphed it into more of a scalable business, and it ultimately was acquired by a big publicly traded company called Gartner Group. You probably know them on the New York Stock Exchange. So it had a successful sort of fairy tale ending, but it didn't start that way. It started back in Perry's office, where I realized just how many mistakes I'd made.
So a couple of questions. How long until you realize, until that meeting, how many years have you been building your business?
I had been building it probably 5 to 7 years. I'd have to go back and think about it exactly, but it was probably 5 or 7 years in by that point.
You have to really to really make it a sellable business.
Yeah. So then from that point, we probably spent 4 years transitioning it into a sellable company. Yeah. I think I was 11 years in when we sold it, something like that.
And just as an idea, how many times more the company was worth the 4 years after you had that conversation?
Well, infinite, because when I went into Perry's office, he said, literally, I can't sell your company. There's nothing to sell. No one's going to buy it.
Wow.
So literally, it wasn't even like, can I get 4 times EBITDA or 6 times EBITDA? It was like, no, I can't sell it. There's the door. Yeah, he was nicer than that. But basically, there's like, I'm not wasting my time trying to hawk some business that's dependent on the owner. And so you need to go find someone else or make some changes because I'm not going to waste my time.
So
Was his answer.
in Built to Sell, you tell a story of a similar entrepreneur that has a design company and focuses and has a mentor very similar and kind of goes through the process. So you were really writing your story.
No, I mean, look, in Built to Sell, there are lots of themes of stuff that I've experienced, but also stuff that I've seen. So my last research company, we focused on helping big companies reach small companies. And so we had 10,000 interviews that we did every year as a company, like a big, huge, massive research book. So I'm drawing on my own experiences, but also from a lot of the research I've done with entrepreneurs and business owners. No, it's not me. I'm not Alex Stapleton. It's an amalgam or a mashup of life experiences. I've had some great mentors, none of them named Ted Gordon, but I've had some great mentors in my life that also have helped. And Barry was one of them. So yeah, there's definitely some autobiographical themes, but I'm not the character in the book. It is, as they say in every fiction book, characters that look similar to this is just purely a coincidence because yeah.
All right. So what really makes a company more valuable or more sellable? Like if you're talking to an entrepreneur that has been 7-10 years building a company and they really want to start thinking about that.
Yeah, I mean, it really comes down to one overarching theme, which has lots of legs underneath it, which is how dependent is the company on you effectively? And that runs through every vein of the company. So how dependent is it on you for top line sales, driving the marketing engine, interviewing the customers, right down to delivering whatever product or service you offer, dealing with suppliers, bankers. I mean, where are you the bottleneck in your company? And if the business can thrive without you, then it's a sellable asset. There's another question that I think we'll get to, which is how do I get a premium for that asset? And what are the drivers of value that would enable me to get an above average multiple for the company? Those are slightly different set of variables. But if you're just asking the question, what makes a sellable business? It's a business that can thrive without you. And that can be a $70,000 a year lawn care company where the person who owns the business doesn't actually push the lawnmower. It's not a sexy business, not going to trade at a huge multiple, but it's a sellable asset. Whereas, as I experienced, you could have a multi-million-dollar company with lots of profit and not be a sellable business if it's dependent on you. So I think that the two questions, what makes a company sellable versus what makes a company valuable, are slightly different, although obviously there's lots of crossover.
So what makes it sellable is if it depends on you or not. If you could build the asset and it could run without you. I
believe that's true. Yeah. And so you think about businesses big and small that are not dependent on the owner. There's someone out there that will buy that business.
Great. So now let's go to the second one. What makes it more valuable? If you want to really maximize the value, what do you have to do?
Recurring revenue is probably the biggest driver of the value of your company. And when I say recurring revenue, people might listen to that and say, oh, he's talking about SaaS companies. And sure enough, SaaS companies get really high multiples. And part of that is the fact that the revenue recurs. Part of it's they're scalable and they're not dependent on people usually. But recurring revenue applies to just about any industry. I mean, you're in the membership business, you've got recurring revenue, and that's great. That'll jack up your valuation. I was talking to some folks in the trades business. So these are people that run, lawn care and painting and, home renovation businesses. And I was explaining to them that the companies that do home renovation, design build type stuff, they're the darling of the industry. Everybody loves those because they make the sexy product and they drive the big truck and they have the great profit margins and they have worthless businesses. right? Because if you're designing a brand new home for every home owner you meet, and you're the one personally doing the design and meeting with the client, you can make a great cash flow business that might scale to 10, 20, $30 million in revenue a year, but it's not a sellable asset. No one's going to buy that business, right? Whereas if you have a lawn care company and instead of charging your customers every time you cut their lawn, you simply charge on subscription and you charge them $100 a month and you're always there to maintain their lawn, that's a sellable asset. And arguably, certainly on a dollar for dollar basis, a more valuable company. So, you can look at virtually any industry. You can look at security, people who install the home security systems. They have the one-off revenue, which is the installation revenue they get for coming in and wiring up the windows and so forth. Then they have the recurring or monitoring revenue. Today, an acquirer will pay about $3 for every dollar of monitoring revenue, and about 75 cents for every dollar of installation revenue. Wow. So said another way, your monitoring revenue, your recurring revenue is like 4x on a dollar for dollar basis. So look, I mean, there's lots of drivers of the value of your company, but there's probably no more powerful way to jack up the value of your business than to create recurring revenue.
Love it. All right. So you're talking to an owner and the owner said, well, why is that important? And here's what I read Build to Sell. And then I went to Babson. I did my MBA in Babson after. And I had a class that they call harvesting. And harvesting is how you collect everything you build, right? And so I talked with a lot of entrepreneurs who said, but I'm never going to sell my business. I'm going to give it to my kids or whatever, right? They don't even think about that. What would you tell an entrepreneur or someone that is building a company and is not thinking about increasing the value or selling it in the future?
Well, I mean, personally, I think, handing your business to your kids is just a very slight shade better than child abuse. I think it's the worst thing you can possibly do in any scenario is give a kid a business that they haven't created. I think it creates all sorts of family dynamics that are just wrought with issues. So I would never recommend that. So that leaves the only option that you've got is either sell it or basically shut it down. And so, I'm a big fan of having an options strategy. And an options strategy, I'm not talking about stock options. I'm talking about having options that are attractive to you. So that could be, you build it so that you could scale it with you in the driver's seat. You could bring in a 2IC, a second in command, and continue to build it without necessarily driving it yourself. You could bring in a private equity group and do a minority or majority recapitalization, or you could sell it to a strategic. All those options are on the table when you have a company that's not dependent on you personally. And so I think by focusing on how do I structure this so that it's not dependent on me gives you the ultimate poker hand. And you may say, well, I don't want to sell. You don't have to sell, but if you have a valuable company, you will get inbound interest. We've looked at people. I know you've got access to the Value Builder score, and we've looked at folks who complete it. People who get a 90 or greater on the Value Builder questionnaire are more than 3 times more likely to get an inbound offer. And again, you may not want an offer, but when you get one, you have negotiating leverage, right? Because you're not going hat in hand to the buyer, they're coming to you. And it's at that point you can set your terms and you've got a much more stronger negotiation position than you would be if you were going hat in hand. So I think it's about having options and having leverage in the negotiation. The other thing I talk a lot about is our role as CEOs. We talk about and we celebrate revenue growth as our ultimate sort of, the ultimate arbiter of how successful we are, right? It's like, pounding our, chest, like, how much revenue do you do, or how many employees do you have? And of course, the person with the most in the room is the alpha dog, or just to use that expression. And I think that's a disservice to us as entrepreneurs, because I think we all know examples of businesses that have scaled without maintaining their margins, or have scaled and undermined their value because they're chasing revenue at all costs. And so I would just encourage folks to think about value is sanity and revenue is vanity. If you're building the value of your company, you're building an asset that you could eventually monetize. Revenue in and of itself is a bit of a fool's errand. I did an interview on Built to Sell Radio with a woman named Stephanie Breedlove. So Stephanie ran a payroll company. She did payroll for parents who have a nanny to pay. And she got to about, she's actually based in Austin near you. And she got to about 300 grand in revenue. So it was her and one employee. And she couldn't figure out how to keep growing. Like she tapped all her mom's networks and, like the classic sort of 1 degree separation, friends and family. And she was like, well, what do I do now? So she had $300,000 in revenue, and every business pundit, anyone who put on a stage or written a book, talked about growth, right? And how it's 9 times cheaper and easier to cross-sell your existing customer a new product than it would be to go find a new customer, right? Like everybody talks about the ease of cross-selling and how, growth is the most important metric. And Stephanie said, but that's not why I got into this business. She got into this business to solve a very specific problem, which was doing payroll for parents who had a nanny to pay. And she said, I'm actually going to keep working at that problem. And I'm going to avoid the temptation of growing at all costs. Because you could easily cross-sell your existing customers, busy parents who have a nanny, meal delivery services, snow removal services, lawn care. I mean, there's a litany of things that busy parents need, right? But she wasn't positioned to do any of those well. And so she decided instead to grow more slowly and focus on the one thing, which was payroll for nannies. She grew 25 years. So you want to think about a slow growth company. She grew from 300 grand in revenue to 9 million in revenue over 25 years. So this is like 10 to 15% growth a year, but consistent, right? Just like a Swiss watch, like every year, 10, 15%. She comes after $9 million in revenue. She decides she wants to sell it. She looks out in the universe and says, who would have a strategic reason to buy it? Care.com was the Angie's List of care providers. It's 7 million subscribers. And she went to them and said, look, if 1% of your 7 million subscribers buy my payroll service, that's 70,000 customers. They had 10,000 customers at the time. Anyways, long story short, they bought that $9 million business for $54 million. Wow. Six times revenue, not EBITDA, 6 times revenue. And I'd ask you, Daniel, if she had done what most people would have told her to do, which was cross-sell other things to your existing customers, how much value would she have created? Nothing. Nobody care would not have bought a snow removal company and a lawn care company. They're not interested. They wanted a pure play payroll service for nannies, and they paid a premium to buy that. And as consumers, we're like cable subscriber owners. Like we all resent the fact that we have to pay for 200 channels we never use, right? And which is why increasingly we're buying Disney and HBO and all the streaming channels. The same thing is true of acquirers. They would rather buy a very clean business that does one thing better than anybody else than a hodgepodge mix of services and products that are undifferentiated. And that's where you see these just tremendous premiums being paid for very clean, very simple businesses that do one thing better than anybody else.
Love it. Guys, if anyone wants to know their score, the score that John mentioned, I'm going to put a link below to an assessment. It will take you 15, 20 minutes, John.
Yep.
And they could get their score and know if they're above the 90 to see if they have the 3 times more probability of being sold. And get
the average score on the valuability questionnaire is 59 out of possible 100. Those that score 90 or greater on average are getting offers that are 2x that of the average business, and they're almost 3 times more likely to get an unsolicited offer. So again, whether you want to sell or not, if you're getting unsolicited offers, it means you're in the driver's seat. You've got negotiating leverage, which is the sort of currency you need to punch above your weight.
And I think what you said about having the options is really important. But most important, as you said, most likely your kids don't like your business. They will not want to operate your business. So.
Well, I mean, that's more like that's probably a conversation for another day. But it's more about parenting philosophy than it is business philosophy. There are lots of examples where, businesses transition successfully from one generation to the next. I just don't think the families transition from one generation to the next terribly well in that situation. I think it just injects a commercial motivation in all kinds of family relationships, and it's just horrible. And we all know thousands of examples of where it's gone wrong for families, not necessarily for businesses, but for families. So I'm just not a big believer in that.
So now let's talk about how to prepare a company for selling. How long before you sell your company? You have to prepare 3 years, 2 years, 5 years. What's the ideal time, and what do you do on those preparation time to be ready to sell at an optimal price and having the optimal sale?
Yeah, I mean, look, I think preparing to sell, and I don't mean this to be facetious, I know it's going to sound that way, is forever. Like, you should be doing it from the beginning. When you start, you should know who your potential acquirers are. That's a facetious answer. And lots of entrepreneurs do approach their business that way. They're always saying, how would this decision, this product, this hire be viewed by potential acquirers? I think that's a very good and sound way to think about your business, even if you don't want to sell it. But when you get on your front foot, which I think is what you're asking, and saying, okay, no, I actually do want to sell this company, you're going to want to eventually build a data room. So a data room is sort of a fancy term for a Dropbox or a Google Drive full of all of your critical information that has some unique characteristics to it, because you'll know when acquirers log into your data room. Once you set up a data room, it comes with notifications that allow you to know when an acquirer who's been given permission to access the documents, you have to grant permission to them. They'll know, and you will know when they log in. And that gives you, again, more negotiating leverage, because you can see which acquirers have logged in. But in your data room is going to be all the classic stuff you've heard 1,000 times, right? All your customer contracts, your employee contracts, all the things that your lease, all the legal documents, the ownership of your, intellectual property, et cetera. So there's all that needs to be put together. I'm not a big fan of doing that. I'm sure most people listening to this, certainly, entrepreneurs that you work with, Daniel, I'm sure are not interested in doing this. That's why a lot of accounting firms have started to offer pre-diligence services. You've heard of due diligence, but pre-diligence is effectively when you outsource it and you go to your accounting firm and said, look, in the next year or two, we want to sell, we want you to build out our data room, and they will build out your data room for you, which is, I think, a service worth its weight in gold, because gosh, nobody really wants to find their lease and upload their employee contracts and stuff like that. Not fun.
Right. Love that. Okay. So they have to be doing it consistently. But when they start doing it, like, how long is the minimum that it will take them to really prepare the company?
Look, I think most acquirers are going to want to see 3 years worth of financial statements. They're going to want to see how you've performed over the last 3 years. So you certainly are going to have to provide them 3 years and some narrative around that. And I think if you make a huge change to your business, like you go from selling direct to selling to a channel, or you go from retail to wholesale, you go from selling from businesses to consumers. I mean, I'm talking about a big change. They're going to want to see 3 years of data with that change in place. So assuming you're not making big strategic shifts along the way, I think 3 years worth of data is going to be what they look at, and they're going to place the most emphasis on the most recent year, but they will look back 3 years. So I would say, look, if you're contemplating big strategic changes, the clock kind of restarts, if that makes sense. So if you were going to say, for the last 5 years, we've been selling to consumers, and now we've made the strategic decision that we're going to sell to businesses, that's a huge shift. And so you're going to probably want to have 3 years of financials selling to businesses before you take that company to market.
Okay, perfect. All right, that's really good. Now let's talk about, to close this, on the difference of valuations of doing a strategic sale versus a financial sale. Very few entrepreneurs really understand the difference. So I would love for you to explain the difference and kind of what's happening in the market on valuations based on that.
Yeah, I mean, well, we've already talked about one strategic acquisition, and that is Care.com's acquisition of Breedlove. So unpacking that, Breedlove had 10,000 customers. Care.com had 7 million subscribers. And so a strategic asset, Care.com would be considered a strategic acquirer of Breedlove and Associates. The reason they're strategic is because they had one fundamental strategic asset, which is a subscriber base of 7 million people, 7 million parents who have a nanny to pay. And so what Breedlove did was said, let's just run the numbers. If 1%, that's 70,000 customers. We're 10,000 today. So that's a business 7 times our size. If 2% of your customers, if 5%, and they just built out a spreadsheet. And because they had that massive asset of 7 million subscribers, they saw to it to spend $54 million for a $9 million company. That's a strategic acquisition where they're placing a value on the business based on what it's worth in their hands, not necessarily what it's worth in the marketplace. So that's a strategic acquisition where, again, they're bringing some sort of strategic asset to bear. A financial acquirer, usually a private equity group, is buying your business for its future stream of profit. Let me say that again. They are valuing your future stream of profit, and they are simply placing a value on that using a discounted cash flow methodology, which, without going into the details of DCF, and folks can Google it if they want to know more, effectively it is impacted by interest rates dramatically and the quality of your earnings, the predictability of your earnings. So acquirers are going to pay more. Financial acquirers are going to pay more for your future stream of profit if interest rates are low, because they can borrow the money to buy your business, giving them a better return. And B, your future stream of profits are predictable, very, very consistent, and they'll pay the most for that business. Now, as we record this, in an interest rate environment where interest rates have been going up a lot, and that is dampening the private equity return on investment model, right? So that's making it harder for them to get the same kinds of returns they were getting when interest rates were very, very low. And so acquisitions are still happening, but more happening when there is profitability in the profit and loss statement. In other words, the private equity group can go to a bank and say, this business is bankable, lend us the money to buy this business because it has profits and they're very predictable. The days where they could borrow money very, very cheaply and oftentimes do that without the business really even generating profit are not here right now. They're kind of over. Whether they'll come back or not remains to be seen. So there's a strategic acquirer like Care.com. Then there's the financial acquirer that's buying your future stream of profit. Again, for the latter group, they're going to care most about how predictable are your profits, how much do you expect to grow them in the future, and then like what are interest rates doing? That's not something you can necessarily drive. And then there's this thing called in kind of a hybrid, which is in between, Daniel. And this is probably the fastest growing set of acquirers. These are financial acquirers, private equity groups that are acting more like strategics. And the reason they're doing that is they're rolling up specific industries. And so there are private equity companies rolling up dental practices, car dealerships, car washes, you name it, whatever vertical you want to pick. I'm pretty sure there is a private equity company rolling those businesses up. And so in that way, they're almost acting like a strategic, right? Because for every new, take a dental practice, for example, for every new dental practice they buy, they enjoy economies of scale. They only need one office manager to do the books. They can get more leverage when they buy supplies and dental floss and all the stuff the dentist needs. They can get better rates because they're buying on volume. And so the more practices that they roll up, the more strategic the acquisition becomes. And I would just call that a strategic hybrid, if you will, because they're not really, when we think of a strategic, like a big Fortune 500 company, but they're also not really just buying your future stream of profits. They're somewhere in between. And so that's why I call them a hybrid. And that's really the universe of people, I think, buying mid-market companies today.
All right. Love it. So what did I miss? What did I not ask that it's important for a business owner to know if they want to sell for maximum value?
Interesting. I think one concept we haven't spoken about, which is one that I'm quite passionate about personally, and that is the freedom point. And the freedom point is the point at which selling your company would create enough liquid wealth for you to do whatever you want, whenever you want to, effectively make work an option for you. And most entrepreneurs blow right past that number without giving it a second thought. And I think that's a mistake, because if we think about our motivations as entrepreneurs, if you really unpack it and ask yourself the 5 why question, I think what most of us come to is our desire for freedom, right? We don't want people telling us what to do. We want to make the call on what work to do, what places to visit, who to eat, with whom, where, whenever. I mean, that's really one of the things that makes us unique. And it's one of the common denominators among all entrepreneurs. And so instead of going to work for Procter & Gamble or Ford, we roll the dice and we start a company. And lots of them fail. But for the folks who listen to this, they're the ones who have succeeded. And they're the all-stars. They're this tiny minority, 4% if you've reached $1 million in sales, of businesses that have achieved that threshold and been successful. And so I think what's an interesting thought experiment is to ask yourself, is it worth realizing the freedom that I've created on paper? Because that was my aspiration in the first place. Because every day you maintain your business and continue to own it, you're like the blackjack player at the poker table, right? You've got all your chips on red, effectively, if we're playing roulette, or all you're all in every day. For a lot of entrepreneurs, I'm sure, Daniel, you've seen this in your own work, it's not uncommon for entrepreneurs to have 50, 60, 80, 90% of their net worth tied up in their business. And if you think about it, that means that every day they go to work, 90% of their wealth is at risk. And we've just come through, hopefully forever, a pandemic, which really taught people that you don't know what's around the bend. You have no idea what is coming. Yeah. And in the event there is some black swan event, are you going to kick yourself for not putting the first rung on the freedom ladder? Like, if you sell your company, it doesn't mean you don't have to do anything. It doesn't mean you have to stop doing what you're doing. It does, however, mean that you are on the first rung of the freedom ladder. You can't be kicked off it unless you go risk it on buying Ethereum or some cryptocurrency. You're literally on the first rung. And until you liquidate the wealth that you have in paper, you're risking it all. And so I just think it's worth asking, when the sale of your business would create enough liquid wealth to fund the rest of your life, do I want to hit that bid? And I think a lot of people, again, as I said in the beginning, blow right past it, not thinking about it. Yeah, I'll sell when I'm old, or I'll sell when it's 10 million or 20 million or 30 million. They've got some justification, some number and the yardsticks keep moving. And I think it's just worth asking yourself the question, am I willing? I think it was Warren Buffett, Daniel, who said, the definition of insanity is risking something you do not value for something you value. And I think for most of us, we value freedom. Like, that's why we're in this game. And effectively what you're risking is freedom in return for another zero on the bank account, which may actually not materially impact your life or your satisfaction, but having the freedom may very much impact your quality of life. So just worth asking, I think.
In the webinar that you taught us, the advisors, 2 years ago, 2.5 years ago, about the freedom point. Yeah. And I remember your graph when you put it, of how the value goes up and then from risk off to risk on. And I was like, no, I couldn't get it. And then you explained it. I was like, oh my God, it makes all the sense in the world.
Oh, is that right? Yeah.
So, I've challenged a lot of my clients that I coach them, that I help them implement scaling up and all these things. I challenge them and said, hey, do you understand that if you sell your company today, you will have more than enough to be free for life, you, your kids? And they said, no, I want to double it. And I was like, I'll be happy to help you do that, but I'm just going to let you know that you're risking already that.
Right.
And so people said yes. And by the way, I've been trading with private equity recently a lot, and that's a game they play really well. Once you pass kind of the 10 million, they come to you and say, hey, you should take some money off the table. the risk of your wife or your spouse, and they start telling you these stories, and it happens. So
and I think it's absolutely legit. And they're good and bad private equity companies. That's probably a story for another day. But you're absolutely right. They come to you when your business is worth maybe $10 million because they figured out that when an entrepreneur realizes their business is probably worth somewhere between $5 and $10 million, that's their freedom point, right? They're like, I don't need any more than that. I don't have some lavish lifestyle. I don't have a private jet. I don't need a private jet. I just want to feel free. And the private equity company will say, look, let's go into business together. I'll buy 60% of your company, right? I'll you can put $6 million in your jeans tomorrow and you pay off the house and feel just like you're set for life. And then we'll roll the dice on the other 40 and we'll grow it and we'll do these 5 different things. We'll buy these companies. And then hopefully down the road, you'll be able to sell that other 40 for, as much as you sold the 60% for. And I think it's a very compelling narrative. Again, I'm not here to blow up the tires of private equity groups. I think, again, as I said earlier, there are some good ones and there's a lot of bad ones. There's a lot of bad actors, but I think if you get in bed with a good one, it can be a very sound business decision, right? Like it's funny. Like when you think about you go to a financial planner and you say like, how is my 401k doing? And they look at you and they say, well, the first thing you need to do is diversify, right? So we need 12% in real estate and 26% in, blah, 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 bonds and stocks. And then, which all makes perfect sense, right? But then we go back to doing our business and realize, 95% of our wealth is in our company. That doesn't make a whole bunch of sense, right? So, and the risk on, risk off thing is when you start your company, it's probably worthless unless you inherited it or you have a truckload of money you invested in. It's probably worthless. And so in the very beginning, it's by definition 0% of your net worth. You may have a little bit of equity in your house, and that's the big thing you've got. But then as your business grows, 5 million in revenue, 8 million in revenue, 12 million in revenue, all of a sudden you go from risk off, where your business is a negligible part of your net worth, to risk on, which is what traders talk about when you're taking disproportionate levels of risk, right? Where the value of your company far exceeds how much you have in the stock market, how much you have in your crypto account, and the value of your home. And that's when you're risk on. And it's, as you're doing with your clients, rightly, I think, Daniel, asking them just to want to make sure you're not trading something you desperately want, which is freedom, in return for something that won't really give you much more quality of life.
I love it. And he gave me, indeed, in the book Impact X, there's a part that we tell entrepreneurs you have to take 2 very important decisions. In stage 2, decide if doing a lifestyle business or an asset or a scale up. And if you do a scale up, once you get to around 80 to 100 employees, that's when you have sell it or not to sell. And that's really when you cross the 10 million. And that will be the last question to close. Why private equity, once you cross the 10 million, they go all the way in to try to buy your company? What happens at 10 million in the US? And by the way, that's something that happens in the US. In Latin America, that doesn't happen where I'm from, and I haven't seen that much in Asia. But in the US, once you cross the 10 million, you get a call every day from a different private equity. So what happens at 10 million?
Couple of things. One, as I mentioned earlier, the private equity group knows that you've crossed the freedom point, and the 2 bite of an apple, the let's take some chips off the table message will land, right? If you're a $2 million company and they're going to buy 60%, you're getting $1.2 million, and that's just not enough to do much with. But they know that once your business is worth 10 million, it's enough. It's enough. And that message will land. The other, perhaps even larger issue, though, is that they have frictional costs in buying a company, and they have a limit to the number of companies they can build and buy, And so when I talk about frictional costs, I mean, they've got to hire lawyers, they've got to hire accountants to do quality of earnings, they've got to actually execute the transaction. And so those expenditures are virtually the same on a $20 million business as they would be on a $2 million business. And so if you can only do 3 transactions a year, they're going to rather do it on the $20 million business. So once you crest that $10 million kind of range, I think the private equity company says, okay, this is now worth our while, so to speak. The other big factor that I think a lot of private equity companies look at is they know that your business, if it reaches that size, is no longer personally dependent on you. And so it's very easy for you to grow a business to $1 million in annual sales and have like virtually everything dependent on you. It's a bit tougher to be a $10 million business and have everything dependent on you. And so they use that as a bit of a gauge or a proxy for how dependent is this company on its owner. And if they've successfully gotten to 10, there's likely salespeople involved. There's likely a marketing department. There's likely, some infrastructure beyond just the owner. And that's another reason they use it.
Love it. John, thank you very much. You're the go-to person. You want to sell a company successfully and how to prepare it. I'm a huge fan of your books. I'm a huge fan of your ontology. That's why I'm a member of Value Builder. It has really helped me to see my business in a completely different way. I pivot my business completely, my business model once. I kind of read your book and understand the valuations of recurring revenue. So you have a really big impact in my life. So I appreciate that.
Well, that's very kind of you to say. I got to now be all nervous about writing another book because I'm going to be like, oh, Daniel's going to screw with his business model again. But write this book. I got to think about Daniel. No, I'm kidding. I really appreciate you saying that. That's very generous.
So if someone wants to follow your work, where should they follow you?
Well, first of all, they should get their Value Builder score. That's really the place to go. So talk to Daniel right below. I think there's a video. Yeah, there'll be a link. I think that's the best place to get your Value Builder score. You can get them to your Freedom score as well. I'm easy to find online. Builttosell.com is around, so there's lots of places to find me. But yeah, I'd start by talking to Daniel about your Value Builder score.
John, always a pleasure. Thank you very much for your time, for your leadership. It's been great.
Thanks, Daniel.